So in this video, I'm going to walk us through several different examples of decision making wherein we incorporate some of the concepts we talked about in the PowerPoint. This first one has to do with something called a special order. This is where we get an order outside of our normal channels, and we need to make a decision as to whether or not we want to take it. So in this particular example, we are a company that manufactures ski poles. We sell them on average for $32 a pair. We have a capacity of 50,000 pairs per year, and I've provided our costs at this level of production. So direct materials run on a per unit basis $12. At capacity, that's $600,000. Direct labor is $3 per pair. At capacity, that's a total of $150,000. Variable manufacturing support or overhead is $1 per pair or $50,000. Then fixed manufacturing support is $250,000, which at capacity is $5 per unit. Variable selling expenses, $2 a unit. At capacity, that's $100,000. And then fixed selling expenses run $200,000, which at a full capacity is $4 per pair. That gives us a per unit cost of $27 for a total cost, if we are at capacity, of $1,350,000. Now, a company has requested a one-time only purchase of 10,000 pairs of skis. They will pay $4 per pair and will reimburse us for the manufacturing costs per unit, both variable and fixed. Currently, our budget indicates that we will only be selling 40,000 pairs of skis, which means, if you think about it, that we have excess capacity. That's a critical piece of information. The other thing to note is we would not incur any variable selling expenses. Perhaps that variable selling expense is a commission, and if the company came to us, the client, then we don't have to incur that. Okay, so what does that mean in terms of what will be additional revenue versus additional costs? So the revenues are defined as a cost plus approach. So in other words, what the client has suggested is that they will reimburse us for the cost of manufacturing plus $4 per unit. So the $4 per unit is 10,000 times 4 or $40,000. The reimbursement for manufacturing is going to be $21. Keep in mind it's manufacturing costs, so we're going to be eliminating the selling expenses, both variable and fixed. So we're looking at $27 per unit minus $6 in selling expenses. So that leaves us with an additional $210,000, so that the total revenues we would generate on this order are $250,000. Now, we will incur the costs. So direct materials will be 10,000 units at 12. Direct labor, 10,000 units at 3. And variable manufacturing, 10,000 at 1. Remember, we won't incur any variable selling expenses. And think about it, fixed manufacturing and fixed selling are not going to be relevant. We have the capacity. Keep in mind, fixed costs won't change just because our sales go up, as long as we stay in the relevant range, which is our level of capacity. So we will incur $160,000 in costs if we fulfill this order. That means we will earn an incremental operating income of $90,000. That's operating income we would not earn if we did not take this order. So there's no reason not to take the order on the surface. Okay, it's going to increase our bottom line. Now, let's change the scenario just a moment, just to illustrate why the capacity is critical. Let's assume that instead of us anticipating selling only 40,000 pairs, we actually are budgeted to sell the full 50,000 pairs that we have the capacity to produce through regular channels. This is going to change the scenario a little. Our sales for those 10,000 units, if we sell them at regular market price, are going to be $320,000. Keep in mind, what we had on the special order was only $250,000 in revenues. That means that if we took the special order by turning down regular customers, we would actually lose $70,000 in revenues. However, remember, we were going to save on the variable selling expenses. That would be a total of $20,000, which the $2 per unit at the 10,000 units. However, if we offset that savings against the lost revenues, we are still going to see a decline in NOI, net operating income, if we take the order. So you can see that if we have idle capacity, then anything we can earn on the order is going to increase our profit. If, however, we do not have idle capacity and taking this special order would require that we turn somebody else down through regular channels, the impact on NOI is a totally different direction. So that idle capacity is critical to our decision. Now, might we make the decision anyway? Sure. Maybe this is a customer we've been trying to get under our belt for some time, and we think if we could give them this special order, they would come back. Now, there may be reasons other than just the bottom line impact to take the order. Okay, let's go to the next worksheet where we have a make or buy scenario. So in this case, we manufacture a component that we use in production of our final product. We can actually go outside and purchase 10,000 of these components for $6 per unit. If we did that, we could free up the plant to be used for something else, save $9,000 plus $1 of fixed overhead would be eliminated. Now, I've given us our manufacturing costs as they currently exist: direct materials, direct labor, variable overhead, and fixed overhead, to the tune a total of $6.40 per unit. So let's identify what's relevant. First, if we continue making the product, what's relevant to the make decision is the cost of the direct materials, which is the 60 cents times the 10,000 units, the cost of the direct labor, which is the $3 times the 10,000 units, and the cost of the variable overhead. Notice the fixed overhead is not relevant because it's going to be there however we choose. So the relevant costs associated with making the product are $48,000. If we buy, first of all, what's relevant is what we have to pay the vendor. That would be $60,000. We indicated that Freeing up the facilities would save us $9,000. Maybe that's $9,000 in utilities. Maybe we would be able to sublet the space for $9,000. Anyway, somehow we're going to get $9,000 of savings back. And then we're going to save some fixed overhead costs, $1 per unit, which is $10,000. So the cost of buying it is actually only going to be $41,000, a savings of $7,000. On the surface, it would appear that we would be better off going outside to this vendor and purchasing the component from them. Now, always keep in mind there are other considerations. For example, right now we have control over this component that goes into our final product. That means we have control over timing of the product, of the component. It also means we have control over the quality of the component. And if the component is going into our final product and the quality deteriorates, that's going to be problematic. Additionally, if there is a delay in getting that component from the vendor, then that's going to slow up our final production and perhaps impede our ability to meet our customers' needs. The other thing I think you also have to consider is what happens to the employees who are currently working on that component. Does this mean we're going to have a layoff? Can they be retrained to do something else? I think if we are caring, ethical managers, we have to consider those things in the decisions that we make. May not be a bottom line impact, but it's important nonetheless. All right, let's look at the next example, which is the concept of either discontinuing or adding a customer or a product line. In this particular example, we have two stores. We have a store in Rhode Island and we have a store in Connecticut. As you can see, the Rhode Island store is losing money. The Connecticut store is doing quite well. So it has been raised, should we just shutter the Rhode Island store? So let's look at what's relevant to this decision. Certainly, the revenues are relevant. If we close the Rhode Island store, we will lose those revenues. Now, there's some argument that those customers may go over to the Connecticut store, but it may be far enough that we would just lose the revenue overall. But if we lose the revenue, we will also save the cost of goods sold. If we are able to get out of our lease, and we'll assume that we can either sublet or we have the ability to cancel, we would save the lease. We would certainly save the labor costs. Now, here's where sunk costs come in. Note that depreciation does not play into this decision. Depreciation is a sunk cost. It's not relevant. We're not going to save anything there. All that we're doing with depreciation is allocating the original cost of the depreciable assets. Utilities we would save. Now, the other one that is a little tricky is corporate overhead. We dealt with overhead when we were talking about segments and common costs. This corporate overhead is an allocated cost. So what's not relevant is how much corporate overhead has been allocated to the Rhode Island store. That doesn't matter, because if it's not allocated to the Rhode Island store, it'll be allocated someplace else. What's relevant is, can we actually reduce any of the overhead, the overall corporate overhead, if we close the Rhode Island store? And the answer is we can. This is situational, but we're told that if the Rhode Island store closes, we will actually be able to reduce some corporate overhead by $44,000. So notice that what is relevant to this decision is the $44,000 in corporate overhead that we can save, not the amount that we allocated. So if we sum up the costs and compare them to the lost revenues, we would actually increase our operating income by $7,000. So again, on the surface, it looks like it may be beneficial to close the Rhode Island store, but there are other things to consider. Again, employees. Do we lay everybody off? Do we lose customers that are frustrated or irritated by the action, and so we lose them anywhere? Is this the right answer, or do we need instead to look at why this store is losing money, and are there ways in which we could save money and therefore save the store? We want to go through these analyses, but never forget that the numbers, the bottom line, isn't all the answer. You need to look at qualitative characteristics, qualitative impacts, as well as the quantitative. Okay, let's look at the next one, which is what's called a constrained resource. This is when there is a particular resource that keeps us from doing something. In this example, we have 5 products. A, B, C, D, and E. Here are the number of units we produce for each. Here's the selling price for each on a per unit basis, the direct material cost per unit, the direct labor cost per unit. Direct labor, they tell us, is $12 per hour, and variable overhead costs are $4 per direct labor hour. So we are allocating our variable overhead on direct labor. So if we look at each one of these and we come up with a contribution margin per unit for each of the products, which again, you remember is just the sales price minus our variable cost. We have direct materials, direct labor, and overhead. And I've just done this for each one. There's nothing magical about this calculation. What we are concerned with is that we have a maximum amount of labor hours. So in other words, our direct labor hours are a constrained resource. We do not have an unlimited amount. If we want to look at which of these products we might back off on because of that, what we want to look at is not the contribution margin per unit, but the contribution margin per hour. So if direct labor hours are a constrained resource, how much are they contributing? How much is each product contributing on a per hour basis? So to do that, we need to know how many labor hours go into each unit or each product. And what I've done there, what I've done there is I've taken the direct labor cost per unit and divided it by the cost, which is $12 per hour. And what that tells us is that it takes 4/10 of an hour to produce product A. It takes 1/4 of an hour to produce product B. It takes 7/10 of an hour to produce product C, 1/2 an hour to produce product D, and 2/10 of an hour to produce product E. Now, what we need to do is calculate the contribution margin per hour. In other words, if we're producing 1 unit of A, for each hour that we spend doing that, what is our contribution? And so all I've done is I've taken the contribution margin per unit and divided it by the amount of time it takes to produce each unit. So for product A that takes 4/10 of an hour, we would actually contribute $62.75 per hour spent on product A. Product B, $70.80 per hour. Notice B has a lower contribution margin per unit, but it takes far less time to produce each unit of B, which means we can produce more units of B in an hour than A. Then look at C. C has a low contribution margin per unit, and it takes the longest to produce. And so what we have is a lower contribution margin per hour of $11.86. Then D, we have a contribution margin per hour of $13.80, and E, $46.50. Now, where are we? Direct labor hours. If we produce 26,000 units of A, it will take us 10,400 hours. B, to produce 42,000 units of B will take us 10,500 hours. C, to produce 40,000 units of C will take us 28,000 hours. To produce 46,000 hours of D will take 23,000 hours, and then E, 90,000 hours to produce 450,000 units of E. So we will need to fulfill that production schedule, we will need 161,900 hours. We only have 150,000 hours. So what do? Well, what we probably should do is reduce our production for product C because it has the lowest contribution margin per hour, which is our constrained resource. So we'll maximize our contribution margin if we pull out of production units of C versus any of the other products. The key factor here is when you have a constrained resource to do the analysis, you need to come down to a contribution margin per constrained resource, not per unit. Okay, let's look at the last example. This is a scenario wherein we are determining if we want to sell a product at a split-off point or process it further. We manufacture 3 products from a common input. So we have this input and we break off and produce 3 different items. We have joint costs of $100,000 and we allocate them to the 3 products based on relative sales value. And the sales value at the split-off point is products X, Y, and Z. If we quit at the split-off point and sell them, we can sell product X for $50,000, product Y for $90,000, and product Z for $60,000. So the issue is we can sell them at split-off, or we can do more processing and then sell them. The question becomes, which one are we better off doing? So what we have to look at is what additional processing costs we would incur, and then what could we sell it for. So product X, if we spend an additional $35,000 beyond the split-off point, then we could sell it for $80,000. Product Y, if we spend an additional $40,000, we can sell it for $150,000. And product Z, if we spend an additional $12,000, we can sell it for $75,000. So what should we do? Well, here's the sales, 80, 150, 75, if we continue processing. Here are the sales if we don't process, if we sell it split off, 50, 90, and 60 respectively. That means X, we would get an additional 30,000 in sales if we continue processing, Y 60, and Z 15, just the difference between the two. But the question becomes, what has to come out of there? And what has to come out of that are the additional processing costs. which for X is $35,000. That means we'll lose money on X if we continue processing. We would actually, for X, be better off just selling it at split off and not doing anything else. On the other hand, Y and Z, we would actually be better off continuing to sell or process and then sell, because we will earn more than enough sales to cover the cost. One last comment on this scenario. Notice that I completely ignored the $100,000 joint processing costs. Those are sunk costs. We incur those to get to the split-off point. They have absolutely zero impact on whether we sell it split-off or move on. They are sunk, spent. We won't get them back. They are irrelevant to the decision.